What have I told you? That there are 7 stocks hiding in plain sight, ready to crush the market in 2025. Well, of course, if you've been watching this channel, your response will be, Paul, we don't know what's going to happen in the short run. And that's exactly correct. In fact, one of these 7 stocks is up 70% this year alone in 7 weeks. These aren't bullshit hype plays. They're wildly undervalued businesses with long-term upside. But I'm not just throwing these picks out there and walking away. We're going to track these stocks quarter by quarter and compare their performance directly against the Mag 7 and the broader market. This isn't just a prediction, it's a challenge. Stay with this channel. I will update you every 3 months on how these 7 under-the-radar picks are stacking up. Are they beating the giants? Are they lagging behind? We're going to let the numbers do the talking. No hype, just results. Now remember, these are just 7 stocks. But the good news is I own every single one of these stocks as part of my 26 stock portfolio. Now remember, guys, these are short-term results that mean nothing. These are my 7 stocks right now. I'm not showing you what they are yet. We have a high of 70% right here, a low of minus 16%, and a lot in the middle. So overall, if these were all equally weighted, we'd be up right now. But again, it's too short run. There's no way to declare victory from that. Here are the actual Mag 7. Everywhere from 16.74 down to 16.5 with the others. So these basically wipe themselves out. So it's down a little bit this year. Isn't that incredible? The Mag 7 is down a little bit this year. Now, this all compares the S&P being up about 2.5% this year so far. So guys, right before we get to this, let me show you guys something interesting. As you all know, we have our 8-pillar portfolio. I put my stocks in here. I sat there and said, okay, what would these stocks look like in an 8-pillar portfolio? Guys, it's not great. 4 check marks, 4 X's here. Cash flow is down, net income is down, but guess what? You might sit there and say, Paul, these are crappy. But look at these valuations, 21 times free cash flow. And all these stocks, I think, have pretty decent return possibilities. Share buybacks, 4.2%. Now, let's compare that to the actual Magnificent 7, and this is going to shock you. Magnificent 7 is 6 check marks, 2 X's. But look at these X's. 62.5 times free cash flow, 55 times net income over the last 5 years. These are 3 times more expensive as a whole than the stocks I've picked. Remember, guys, the number one thing and the 4th pillar in our principle-driven investing is a great story can become a bad investment if you pay the wrong price. You're paying 3 times more for cash flow in this Magnificent 7, the real one, versus mine. So you might sit there and say, yeah, but there's better growth potential. Great, let me ask you a question. If you paid 1 times free cash flow on mine, you got all your money back in 1 year, would that be a better investment than the best growth story out there? If your answer to that is no, I'm not the channel for you. If your answer to that is yes, we're the channel for you. If your answer to that is, I have no idea, stick around because this is really, really important. A great story at the wrong price is a bad investment. So let's break it down on stock number 1. Sprouts Farmers Market has been on a tear, and it actually has fallen quite a bit last week. They had great earnings, hit an all-time high of $179 per share. They're down to $140, but you guys know that's not what I care about. In the short run, what I love is Sprouts Farmers Market, profit margin almost 5% and growing. Why? Smaller, more efficient store model that drives higher sales per square foot and better margins. And they're increasing the Sprouts Farmers brand within the stores, which has 50 to 60% gross margin compared to the 38% gross margin this company has. Unlike legacy grocers that rely on price wars, Sprouts has pricing power, supply chain efficiency, and smart cost controls that work in its favor. And guys, this is a high niche store. This company focuses on specific niche products with higher margins. Kroger does 1 to 2% bottom line. They're already at 5% and growing. And the best part is they only have a little over 400 stores with potential of getting to 1,200 to 1,350 stores. This company is not only going to grow their bottom line, they're also going to grow the number of stores they have. This is a compounder. But I do think that at 46 times free cash flow in the last 5 years and 35 times last year might be a little rich. So it's not something I'm adding to, but it's something that I'm going to keep compared to Old Paul. They have a great balance sheet, and it only costs them about $4 million to open a store, and they get really high returns on the money invested in their business. Now, that stock's a little bit under the radar, but what about the next one? It's a household name, yet most people overlook just how powerful it really is. And get this, while the entire industry they're in struggles to even make money, and usually all of them have bankruptcy at some point in their history, this one is different. Southwest Airlines. Now guys, my biggest concern about Southwest is it's an airline. But my big thesis on this one is if they can get back to margins they had before COVID, they are going to kill it. Airliners are notorious for being terrible investments. They have high debt, razor-thin margins, and constant boom and bust cycles. But Southwest is the rare exception. This company before COVID was the only airline to make money in over 47 consecutive years. And their secret sauce is their relentless cost discipline. They only fly 737s. So what does that do? It lets them focus on one plane, the maintenance, the parts, everything. Their turnaround times are lightning fast, and they master the hedging of their fuel. Plus, customers love it. No baggage fees, a cult-like rapid rewards program, and strong brand loyalty. Now, Elliott Management recently just took some control in the company, and they're changing a few things around, but they're sticking with the model that works, which is sticking to one plane and sticking to routes that make a lot of sense for them. This company has the most potential out of any of the companies I have, but with that means it has the worst probably image of every company we have. So let's check this thing out. The profit margin last year was 1.7%. If you go back to before COVID, they were consistently in the 10 to 15% margin area. Guys, if they just get back to 8%, forget about 10 to 15, this company is a $60, $70 company in my opinion. And as long as they don't become like the other airlines by starting to go on routes that don't make sense and starting to buy planes that don't make sense, this company has major potential long-term. All right, so we've covered grocery stores, we've covered an airline. Now let's talk fintech. Most investors have completely written this next company off, but I think there's a massive mistake and the juice is well worth the squeeze. In fact, while everyone's distracted by the AI craze, this company is quietly stacking up billions in cash flow. What's that company? PayPal. PayPal has gone from the fintech darling to investor headache. Look at the stock price, all-time high of $310 back in 2021. The company is better today, has more revenue, still growing. This company is a cash-generating machine. Look at this, guys. $6.8 billion in free cash flow last year compared to $4.1 billion in their net income. This company is quietly building free cash flow that people are not paying attention to. They process over $1.5 trillion annually with over 400 million active users and over 200 million merchants. Guys, competition is fierce, and that's probably the biggest hindrance here, but they aren't sitting still. They bought Venmo, and Venmo is evolving beyond consumer to consumer and now powering merchant payments, crypto transactions, and small business services. Meanwhile, PayPal Complete Payments is attacking the enterprise space, and Buy Now, Pay Later is fueling even more growth. Now here's the kicker. This free cash flow and aggressive stock buyback, this is killing it. Guys, when you have a company selling for 11 times free cash flow and they're taking that cash to buy back stock, you look at a company that understands that buying back cheap shares is the best thing for investors. But guys, they're deeply embedded in global commerce. In fact, my personal anecdote is whenever I'm buying something that I can buy with PayPal easily, I do it, especially if I'm wondering, is this vendor legitimate? They have great financials and they have massive secular tailwinds in digital payments. They could be an undervalued compounder hiding in plain sight. Now guys, this next company, this is what's interesting. They have 90% market dominance in its field, and it's quietly becoming an AI powerhouse. In fact, many people think that AI is going to eliminate it. I don't agree. I think AI is going to make it even better. What company is that? Adobe, the backbone of digital creativity. They're not just another software company. From Photoshop to Premiere Pro, its Creative Cloud suite has become the industry standard with high switching costs that keep users locked in for the long haul. When you've become embedded in Adobe products, you ain't leaving. If you're serious about creative work, you're using Adobe because it's the trusted standard that creators genuinely rely on to bring their visions to life. Now that real opportunity lies in AI, which is all the craze right now. Tools like Adobe Firefly and Sensei are enhancing automation and boosting productivity, giving Adobe even more pricing power. And on top of that, their digital experience segment is quietly driving growth by helping businesses deliver personalized marketing and better customer analytics. They have over 40% operating margins. Guys, look at this. They have gross margins that are almost 90%. Every extra dollar they sell has 90% of profit in there. This is the type of business that keeps growing quietly in the background while the market chases the next shiny object. Guys, look at this. This company that people think are going to be dead, analysts project revenue growth of double digits, basically a year for the next 4 or 5 years. They are analysts. They have their bias. But I look at this company, earnings per share growth over 10% per year. How is that a dying business? Okay, we talked about creativity, digital dominance, but here's where things get interesting. The next company is one of the biggest e-commerce giants on the planet, yet it's trading like a bargain bin stock. And the crazy part, it actually might be more profitable than Amazon. That company is the one that's up 70% year to date, Alibaba. China is the big fear here. Their e-commerce and cloud powerhouse is Alibaba. They're one of the most dominant businesses in China, and yet it's trading like a bargain bin stock. Now, it has surged so much this year that it's not the bargain bin it used to. But when it was sub 100, you got the attention of Michael Burry, Tepper, all these great hedge fund managers said, wait a second, let's look at this. In fact, 2 of the guys in the Big Short have said that BABA might be the most obvious value play. Is that a good thing? Maybe. But everybody's sentiment about China is absolutely scary. What's my sentiment? China is the fastest growing middle class in the world. That's going to help a company like Alibaba. And they don't have to have a lot of capital expenditures to build this business. In fact, they create 25%, over 25% EBITDA margins, miles ahead of Amazon's sub 5%. Plus, its international push adds fuel to the growth engine. And guys, Alibaba Cloud, which holds a 35% market share in China and is riding the AI wave. And guess what? Cloud penetration is under 10% in China still. So that gives a lot of runway there. Add in the Ant Group's fintech dominance, $80+ billion in cash and a $25 billion buyback program, and you've got a company quietly compounding value. Their share repurchase is so freaking intelligent. I absolutely love it. The market was shitting on them, and they were sitting there saying, fine, we'll just buy back stock, and they've been doing it consistently. I think Alibaba is a multi-bagger for many years to come. But this short-term 70% surge should not be looked at as, aha, anything can happen. Now, this next stock is playing a totally different game than the companies we've looked at so far. It's dominating an industry that never goes out of style, with 40 million loyal customers driving insane repeat business, and it's still growing. Do you have any guess for it? I guarantee, especially with the demographic on this channel, that you're not going to guess it. Ulta Beauty, the one-stop shop dominating the beauty game. Guys, they're not just another retailer. It's the undisputed leader in the $100 billion plus US beauty industry. What's its secret? A unique everything beauty all-in-one place model that blends mass market, prestige, and luxury brands under one roof, creating a one-stop shop that keeps customers coming back. They have over 1,300 locations and 40 million strong loyalty program. They have absolutely nailed customer retention. Add in personalized services like salons and skin treatments, and you've got a shopping experience department store just cannot match. And guys, guess what? On this company, the past companies, and the future ones, we've barely talked about numbers. This is just the story. The numbers make even more sense. And for Ulta, the growth story doesn't stop there. E-commerce now accounts for over 20% of revenue, and investments in AI-driven marketing, augmented reality beauty trials, and same-day delivery are setting Ulta up for the long-term dominance. Guys, retail's tough, but they're sitting there saying, we're going to survive, and they're going to survive by making it easy for the consumer. As it leans into high-margin private labels and exclusive brand partnerships, Ulta isn't just growing, it's becoming far more profitable. In a world where beauty never goes out of style, Ulta's upside looks just as good. All right, guys, final stock. And honestly, this might be the smartest bet of them all. It's not just dominating its category, it's redefining it. And with billions in brand loyalty, massive expansion plans, and a game-changing shift in its business model, it could be a long-term compounder that quietly outperforms. It's a company that when it was at its all-time high of 180, people said no chance it goes below 100. And look where it's at right now. And that company is Nike. And it's currently up 5% today at $80 per share. But this company was at 180 a mere 3.5 years ago. And of course, as the stock fell, what I hear from people, Nike's dead, they're losing it. But guess what, guys? They aren't just leading the game, they're redefining it. Over 40% market share in global athletic footwear. Its moat is a combination of innovation, brand power, and a growing direct-to-consumer presence that now accounts for over 40% of revenue. Guys, with direct-to-consumer, they're getting higher margins there. They're going to drive this 45% gross margin even higher. They can spend more money on advertising because they're now not selling wholesale pricing to the stores. They're expanding into high-growth categories like women's apparel, running, and sustainable performance wear, tapping into fresh revenue streams. Guys, look at women's. The Cleveland Rockers are a new WNBA team that Dan Gilbert just paid $250 million to get the rights to. Guys, 25 years ago, you could buy an NBA team for $250 million. Now the rights to this WNBA franchise, which was already in Cleveland years ago and failed, was now $250 million. The future in sports is women's sports, and Nike is at the forefront. But they're also growing incredibly overseas. It's Nike's second largest market in China, along with Latin America and Southeast Asia, offers significant runway as rising middle classes embrace fitness and lifestyle trends. They're optimizing supply chains, automated manufacturing, and AI-powered personalization. And this is margin expanding machine. With consistent free cash flow, aggressive buybacks at the right price, and a projected revenue push past $60 billion by 2030, Nike could easily 3 to 5x over the next decade. But guess what, guys? You've got to remember that any one of these stocks that I just mentioned could do any random thing in the short run. You're never going to buy a stock at the bottom. If you're still watching this, I can tell you're not someone who wants to be given fish. You want to learn how to fish. You're serious about finding great stocks and getting ahead of the market. So why stop there? In my full course linked below at the screen on the right, I go even deeper, breaking down how to find stocks before the crowd, how to analyze financials the right way, and how to build a portfolio that compounds for years to come. Thank you for your time.